My name is Sydney. I'm going to be the moderator today for the SheFunds Academy webinar. We're going over DSCR loans and rental portfolio growth. I am the Chief Operating Officer for Simplending Financial. We're a nationwide private lender based in Houston, and also co-founder of SheFunds alongside Janine. So today I have joining me Sara Hootstein, who is the Director of Finance of America Commercial. Sara, do you want to share a little bit about what you do?
Sure.
Sorry, Sydney, there's a really loud echo.
It's okay.
My name is Sara Hootstein. I am a director at Finance of America Commercial. We do nationwide private lending for 1 to 4 unit properties.
Easy peasy. I love it. And then next I have Ayanna Nicole, who is a Realtor and Property Manager. Ayanna, go ahead and introduce yourself as well.
Hi, everyone. So my name is Ayanna. I am a property manager and realtor here in Houston, Texas. I've been doing property management for over 10 years now, so about 12 years. So I manage small portfolios, so investors that have one property up to investors that may have 100 or plus units.
Perfect. Thank you, Sara and Ayanna, for joining me. I'm going to go ahead and continue on to the next slide, and we'll continue on with any questions as well. There you go. Okay, so what is a DSCR loan and how does it work? Sara, I'm going to ask you the first question. Walk me through what a DSCR loan looks like and how it differs from your traditional, conventional property loan.
Perfect. So a DSCR loan is a debt service coverage ratio loan. Basically, what this means in short is your expenses have to be less than your rental income, right? We want to see that you're generating positive cash flow. These loans are not reported to your personal credit, and they are always closed in the name of an entity, right? So we're not closing in your personal name. Most lenders who want positive cash flow. There are some lenders who will go below a 1.0 debt service, but I would say the majority in our space need at least a 1.05 or higher debt service. In simple terms, all that means is that your rental income is 1.05 times your expenses. That's basically the easiest possible way to explain it. On these loans, we are not necessarily looking at your DTI. We're not getting tax returns. We are truly, truly looking to see that the asset carries.
Yeah, pretty simple, easy enough for how a DSCR loan works. It's one of my favorite programs, honestly, that where you can offer to investors because, I mean, a lot of the time we have investors, right? And so they're not looking to do their tax returns. They're not looking to qualify for a loan in that way. They want to qualify the loan based off of their property and what's working. So the cash flow, exactly. And yeah, it's one of my favorite loans that we get to offer, honestly. Ayanna, so this question is a little bit more tailored to your investors that you work with. So when did you first come across, I guess, being able to assist your landlords, I guess not exactly property managers, because you're the property manager, your investors, how did you come across DSCR financing being an option for them to utilize for their investments?
Yeah, so connecting with lenders, they let me know. I had a lot of beginning investors coming to me, and the thing about newer investors is they think that they have to qualify based strictly off of their personal income, tax returns, W-2s, and it could stop a lot of people from, especially beginning investors, to scale. So one thing that I love about the DSCR loans is that it shifts the focus and more towards the property's ability to perform and generate income.
Yeah, exactly. It's all about performance. We do have a question from Eric right off the bat that I do want to go ahead and address. He says, could one get a DSCR loan on a buy and hold that will be undergoing rehab? Meaning, will a DSCR loan be given based on future cash flow after the rehab? So I guess there's two parts to this question, right? So I can go ahead and answer it, and Sarah, if you want to chime in too, more than welcome to. So typically the way that DSCR loans work is we want to see that the property is stabilized so that there's no work being needed, there's no deferred maintenance being needed, maybe besides something that's like paint, if anything, but anything that like might have a hole or like actual renovations are happening, you're not going to be able to qualify for a DSCR loan, at least on my side. I know some companies, they kind of differ with what they allow and what they don't allow. But as for the DSCR being given based on the future cash flow, if the property is vacant, you just purchased it, or it's being it's being renovated, the renovation just got completed, you can still qualify for a DSCR loan. We just go based off of the market rent and instead of the actual in-place rent. So there's kind of case by case where it works, but if something's needing like actual rehab, typically we want to see that it's all completed prior to funding the loan. And Sarah, if you have anything to chime in with, you can.
Yeah, I think this is most applicable to like the Burr method investors. And listen, I think many people have tried for many years to find a true product that converts the bridge to a DSCR without making someone take out a new loan. But I don't know that one has been found, right? Capital markets are very different for the short-term strategy versus the long-term. So the best solution for you would be to take out a fix and flip loan, get in there, do the renovation, then do a cash out refi, and then take that cash and buy another property. So it is two separate loans, but oftentimes a lot of the things that are used from the fix and flip loan are helpful to originate the DSCR loan a lot quicker, a lot easier. Your bridge loan is going to be at a lot higher of an interest rate than your DSCR loan. So that's part of the reason. But not only do we want to be able to use the stabilized rental income, but we want to also be able to use like your after repair value. So if you have a property that you know is going to be a long-term hold, but it needs $25K of work and to get the value where it needs to be, do the fix and flip loan first and then the cash out refi after. A lot of lenders have specific like promos, or they don't charge as many fees if you go from the fix and flip to the DSCR with them.
Yeah, and I can speak from just like personal, I guess, experience being a lender too. We love to keep repeat business. So if we are giving you the flip loan and you're wanting to hold it, we would love for you to come back and do the DSCR with us. So more often than not, we are able to extend over discounted points or discounted rate or something to be able to help earn your business and just keep you as a repeat customer. But we will go ahead and go on to the next slide. How lenders evaluate rental income. We kind of discussed this a little bit with that last question, but Sarah, what does the underwriting process actually look like and what makes or breaks an approval?
Yeah, so most lenders will get the lease. Sydney, you mind muting?
Sorry. Yep, 1 second.
Me hearing my own voice is like nails on a chalkboard. So anyways, sorry. Rental income. So we will get a lease as well. We'll get market rent on an appraisal. We'll use the lower of the two. Most straight DSCR products don't go off of Airbnb rental income. It is based off true 12-month market rent. And again, we'll use the lower of the appraisal versus market rent. And the reason we do that is because if your market rent is significantly lower than what you're actually getting, if those tenants stop paying or move out, we need to be able to make sure you'll be able to get at least market moving forward. Traditionally, I very, very rarely have scenarios where market rent in the appraisal is that different than the actual lease. I think it's pretty rare that this actually affects the deal. The main thing for rental income underwriting looks at today, and some lenders have loan products for this and some lenders don't, is it like rent by room? Is it pad split? So there's a lot of those questions that they need to answer when they see the appraisal. Are there individual locks on every door? Does it say, Sydney Payne is renting this room for $500 and Sara Hootstein rents this room for $700? And, when you get that appraisal back, it's very clearly like rent by room instead of rent by house. So just if you have a property that is pad split, if it's an Airbnb, if it's student housing, that's just something to let your lender know up front, because some lenders have specific guidelines around how they view income for each of those scenarios. So you want to make sure that you're going with a lender who actually fits your box.
Yeah, perfectly said, Sarah. So for Ayanna, this question I have for you, I'm going to pivot it just a little bit. How do you, as a property manager, position your properties that you're managing, property managing as a property manager? How do you kind of position those to perform well? So are you helping do the Zillow listings? Are you helping with, suggesting over to your investor what they should list it for? How are you kind of going about that?
So yes, absolutely. Anytime an investor comes to me inquiring about property management, the very first thing we're going to do is something called a rental analysis. And so I am looking at the entire property as a snapshot. So I'm analyzing things like the rental comps, the neighborhood demands, average days on market, conditions of the rental, kind of piggybacking off of what Sarah says, making sure is there doorknobs, all these little make ready things. I'm paying attention to the operational side because that's a lot of times where investors struggle and a property may not qualify. But if the property management is poor, the maintenance is deferred, the property isn't positioned for the market, then the performance suffers altogether. So that's something that I'm doing. If I can get to you before you even make an offer on the property, that's something that we're looking at to help the lender. But if I get it after you're already under contract, I'm still going to do the complete rental analysis, making sure everything is ready for us to go under management to make sure that your property is performing no matter what we're doing, whether it's long-term, mid-term, plat split, whatever we decide during that rental comp.
And so as a property manager, you're kind of in a way representing both the lender, or not the lender, sorry, the investor, but also the actual tenant too, in some ways, with helping with maintenance stuff, helping like if there's any last minute urgent things that need to happen or any questions on the property, which is very unique position to be in, is like right in the middle there. You're representing two different people, and one's giving a service and one's taking the service. So how is that for you, I guess, as a property manager? How's that experience?
Well, it can be tricky, but right off the back, I'm letting my client, which is the investor, the landlord, know that your business, and a lot of times investors and landlords forget, you're in hospitality. And I say that is because, and not just the Airbnb side, I'm speaking long-term rental as well. If your tenant is not happy, then they can move out, or your home sits vacant. If the property isn't made ready, your property is going to sit vacant, which is going to cost you money at the end of the day. So I'm automatically letting my client know that, hey, yes, I work for you. You're paying the bills, you're paying my invoices, things of that sort. But we also have to make sure that we're resident first. And that's just something that I let them know right off back. And surprisingly, a lot of my landlords love that, because at some point we were all tenants at some point. And so they're like, I wish my property manager or my landlord thought of me in that way. So it's just an expectation that I set way off front. And then one of the things that I do, which a lot of property management companies don't do, is I make sure that either I meet the tenant in person or I get on the phone and introduce myself as the property manager. I do have a team of people that also help me, but I want to make sure that they hear my voice. They understand that I'm here to help them. So, and they have my email. If there's anything that they need, I tell them how to get on the portal, put in maintenance requests, and we're here to help. We're not your enemy. We're not just taking your and excuse me, guys, I have pregnancy brain. So if I go blank, I am so sorry. We're not just taking your rent and just calling it a day. We are actually here for you, and we want to keep you here for the long term. We want you to renew with us.
Yeah, and I think we've probably all had experiences with bad property managers. I mean, my current property manager, she's not the best, honestly. It took me over the winter time. Gosh, there was my gas permit was expired, and she wouldn't let me know if I needed to handle it or if she needed to handle it. And she handled it, but she didn't let me know that the updates along the way. So it took like 2 months, I think, for us to get heat in December. And we were able to actually get it literally the day before that big freeze happened in like January-ish time. It was not fun. And I mean, I've been a tenant with them for going on 6 years now, but that's been my biggest my biggest downfall, I guess, is like my property manager. She's not the best. So we all love to have a great customer first property manager around here.
Yeah,
Janine
yeah.
has to, oh, sorry, go ahead.
I was just going to say, hearing that you've been at that property for 6 years is music to my ears. It cost what a lot of landlords don't understand, especially first-time landlords and investors, is that turning a unit costs so much more money than renewing. So if you're someone that pays on time, doesn't give us issues, we've never had to file eviction on you, we need to figure out what it is that we can do to retain you. And something that I do every 6 months, first off, is I sent over a survey to the tenants. How are we doing? Is there anything that we're missing? Is there any work orders you want to do? And we typically like to do that during our semi-annual inspections. So this is just staying on top of that extra layer of, let's make sure that everyone's happy, everyone's on the same page, so that we can renew you once your lease term is up.
Yeah, no, I love that. I'm sure that anyone who's an investor here doing long-term long-term rentals, they'd love to hear that and probably love to get to talk to you too. Janine asked a question, and this is the question on everyone's books, I guess, is how fast can you close on a DSCR loan? I was actually looking at it this morning. I was on a call with a broker, and she was asking how long does it take for us to close on loans. So I was going back through my pipeline, and we have a couple, like as recent as like the last couple months, that we've actually closed within 20 days a DSCR loan. So Sara, what's the fastest that you've closed a DSCR loan?
The fastest I've closed a DSCR loan is probably like 2 weeks. I will say it wasn't tenant occupied yet, so like scheduling the appraisal was the easiest thing in the world, right? It was like one of those true BRRRR methods where they finished the rehab, submitted it that same day, had an appraiser out 2 days later, had everything in, happened to get a lease like 12 hours later, and just really, really like dotted their I's and crossed their T's. It's definitely not the average. But I always tell people we close as fast as you allow us, right? If it's a quadplex and we do need all 4 of those units to be inspected and 3 of your tenants let the appraiser in and the 4th says no, that's going to delay things. If the appraiser calls you, leaves a voicemail, and it takes you 2 days to call back, that's going to delay things. So I'll push the appraisers the best I possibly can on my end, but it never works unless I have your support. Also telling us up front who the right contact is, right? When you're submitting that DSCR loan and getting that quote, if you have a property manager, right, you should be telling us that right then and there and giving us their contact info, because they're going to be able to schedule that inspection a lot easier than you will. So having us go right to the property manager instead of calling you and then you coordinating with the property manager and then them coordinating, like it's just a pain. Give us their number, we'll give it to the appraiser will call Ayanna directly, and we'll get it done. And just really making sure that your tenants have that heads up, like, hey, I need this person to get access this day at this time, like, is very, very, crucial to the process.
And Sarah, if I could say, your property manager knows your lease. So here in Texas, we have to give a certain amount of notice before we can just enter unless there's like a big emergency. So to keep the process going, like she was saying, let the property manager, give them the property manager's contact information so we can go ahead and send out notices and get everything moving so we won't delay anything.
Yeah, both very important keys is to have good relationships with the property manager and then the investor as well. Just the communication. Communication is always the key, right? That's what I try and emphasize as much as possible is communication, and the dot collection moves everything along a lot smoother. Okay, we'll go ahead and on to the next slide. Okay, when DSCR financing makes sense. Sarah, what profile of investor or property is DSCR financing best suited for?
Yeah, and I think Raven actually was just talking about this in the chat, so it's like perfect timing. But listen, we will qualify the guarantor as well. For our particular guidelines, we want 660 FICO or higher. And as I talked about earlier on the rental income slide, a 1.05 debt service or higher. So when we are qualifying an investor, I'm looking that there's no outstanding tax liens, no recent bankruptcies or foreclosures. Again, over 660 FICO. I can't have someone that has mortgage lates in the last 12 months. And then when we get to the property, it's really just a cash flowing property. For example, it's sometimes difficult to get a super cash flowing property at high leverage in certain parts of the country where taxes and insurance are also very high, but rental income maybe didn't come up with it. So sometimes you're able to qualify loans at, let's say, 50 LTV, but not 75 LTV. And so just knowing what works for you and how much cash out you need is important. I think that anyone can buy an investment property. I'm not necessarily looking for the profile of someone who owns 10 properties and is trying to buy 10 more. We also want to help the first timers who are trying to get into real estate for the first time ever and really help them learn how to grow their portfolio and grow by their side instead of focusing on just those kind of like people who are already well established in the industry. It's at the end of the day a relationship business, and helping someone grow from the ground up is really a fun part of this business too.
Yeah, I think one of the reasons why DSCR financing is one of my favorite is because you can get very creative with it. And yes, there's the guidelines of like the bankruptcies and foreclosures and mortgage rates and everything. But when it comes down to like the actual DSCR ratio and I guess the property itself, there's some flexibility that we can kind of go alongside with. Like if someone's insurance premium needs to be a little bit lower, we can shop that and make it work. If there is something within the LTV that they're looking for a certain cash out, we can kind of work and make sure that it fits the needs of the borrowers. Really, I think that's something that I try and focus on is like, okay, what do you need? Do you need just the payoff? You're looking to get out of your short-term loan because it's maturing, or are you looking for cash out? And like that's what you want the maximized numbers for, because rate and term versus cash out, the rates are going to be a little bit different. So if you want the lower rate, might be better do the rate and term, even at a lower LTV percentage in comparison to the cash out. With getting the maximum cash out, you will have that higher rate. Let's see. I think Bridget, completely new, except for my personal home, looking for mentorship and guidance. That's perfect, Bridget. That's what we're here for, is to give the mentorship and the guidance. And then Raven, I just want to make sure that we got these questions answered. Does one need to take a class class in order to learn more about the DSCR loan? No, not exactly. So within private lending, you don't necessarily need to be licensed to know about the ins and outs of a DSCR loan. Where in comparison with the conventional side, you need to have the NMLS and go through all of your hours and the courses there. Diana asked, how long does one have to be on title to get a DSCR loan? Typically, it depends on if you want to do a rate and term or a cash out. Cash out is usually going to be about 3 to 6 months. It does kind of differ lender to lender. And then the rate and term is usually going to be about 30 days. I don't really see anyone going any lower than those time periods because of the issues of fraud and straw borrowers and things like that. I've seen quite a few scenarios where someone is trying to do a cash out, but their credit score doesn't qualify, so they're trying to just add a person in the last minute that has nothing to do with the property. That's like someone's cousin that has a higher credit score just so they can get qualified for the loan. And that's not something we can that's acceptable on our side. And let me see. Raven also asked, does one have to put down 20% to secure the property? Essentially, yes. The highest LTV that at least I'm able to go to is 80% LTV for a purchase, and that's if the DSCR all works out. So as Sarah was mentioning previously, it all goes into a ratio where it's the taxes and the insurance and the monthly payments versus how much income you're making. So if you're purchasing a property and your property's market rent is lower than what you anticipated, we'd have to lower the loan amount, lower the LTVs to fit that monthly payment so that you're not coming out of pocket monthly to pay your monthly dues. So case by case, more often than not, we are able to do the max LTVs, but if there's ever a scenario where it comes in low, it would need to be adjusted. Ayanna, your question, I'm going to pivot just a little bit too. How do you identify properties that are a strong fit and struggles that might want to qualify? So we're going to move it around and say, how do you identify properties that are going to be strong rentals, strong comparables, versus ones that might kind of struggle to be rented out within 30, 60 days?
Yeah, so I'm looking at a couple things. The very first thing I'm going to look at if it's in a strong rental demand area, and also if it's in stable neighborhoods. And one of the things that I like to look at is actually go to the property and look at the condition of the property itself. We found I've rented out over 120 units by myself as a realtor on my realtor side per year. And then on the property management side, we lease all of our units. But one of the things that people love to look at, tenants love new. If it's new, it's better. So they're looking at the colors of the walls. They're looking at the color of the cabinetries. They're looking at, is it TikTok, Instagram worthy? So we're actually looking at the conditions for the tenant side because I'm going in looking at it as a tenant. And then on the investor side, I'm looking at it as far as stable neighborhoods and if it's a strong rental demand in the area. So I'm looking at it on both ends.
Yeah, I love that too. And then you also being a realtor too, you kind of, you have access, I guess, to what actual rental comps that there are. And I'm curious though, just for my own knowledge, I'm sure someone else in the crowd might be interested too, but when it comes to being a realtor and helping with people find rental properties, how does that kind of work? Because I know that obviously realtors are for selling homes, but realtors can also help with leasing places.
Yeah, and that is actually where I stand out. A lot of realtors go in getting their license and they want to sell homes, and they want to sell the $1 million homes, and they want to get the big ticket sales, right? The only job I've ever had coming out of high school has been in property management. So I kind of just gravitated towards rentals, and I love it. What realtors don't realize is all you need is maybe 10 rentals a month and you can make $10,000 a month. There's realtors that are not making that in a month. They may not get a sale for 2 to 3 months. But what that looks like for me is I have made myself as the rental expert here in Houston. So my whole social media profile is based off of rentals. Here in Houston, what is really, really popular is townhomes and apartments, high-rise, mid-rise apartments. So being the expert in that, I am heavily, heavily marketing on social media. Majority of my clients come from social media, and the other half may come from referrals. So being a realtor and renting out, helping the consumer, which is the tenant, I'm able to understand and be the expert and let the landlords know exactly what tenants are looking for when they're going to buy their investment property.
Yeah, I think that's a very special place to be in, especially just to be the expert in Houston. Houston, I always tell people, is like a renter's market. So to be able to like have that grasp on the market too is I mean, incredible to see and incredible to have, and I think a very useful asset. So I'm sure that you're a lot of help to a lot of people, which is what I love to see. We'll go ahead on to the next slide. How investors use rental loans to scale. Sara, how do you see investors using DSCR loans strategically to grow a portfolio over time?
Yeah, so I talked a little bit earlier about the BRRRR method, and that truly is the way to scale if you're trying to dive headfirst into this business, right? So for anyone who doesn't know what the BRRRR method is, it's buy, rehab, rent, repeat. And so you buy a property, needs a little bit of work, you rehab it, get it up to market rents, make sure that it's, you're going to get the most out of it. Then you refi, take that cash out from the cash out refi and repeat the process, right? So you're using that cash out to buy more properties. And this helps someone scale because if they're currently buying, one property a year, all cash, by transitioning to the BRRRR method and using some of these, they can maybe buy 3 properties a year. There is obviously some caution. You don't want to scale faster than you can handle. You want to make sure that if you are buying 7 projects a year, if one of those projects doesn't go exactly according to plan, you'll still be cash flowing positively, right? At the end of the day, projects go wrong. You buy a property, get in there, and it needs double the work you thought. Or you have a tenant-occupied property 3 streets down that had a fire, and now you're dealing with insurance claims. And how is that affecting the rest of your portfolio? And are you cash flowing the rehabs enough? So I say use the BRRRR method to scale, but really know your limits and decide what level of risk you're comfortable taking, so that way you don't get stuck. And a good way to do that is definitely having a property manager who can advise you throughout that whole process as well. But I think that's one of the main things we look for as a lender. We want to see that you're in good standing. We do not have exposure limits often in this kind of realm in private lending. And so we want to know that your business plan is going okay. And something we do always ask borrowers on some of our high exposure calls that we do for check-ins is tell us about a project that went bad. And honestly, the people who say it's never happened when they have that many properties, we're kind of like, that's BS. Just tell us. It's not a bad thing, because getting some of that out and hearing how people handle that can help them scale, because it talks about all the different resources they use. They made different business partnerships to solve a lot of these problems and can really help in the long run.
Yeah, most definitely. And the BRRRR method is something that's really popular right now, just within the lingo of the real estate world. So yeah, using that kind of strategy, it really depends on your business plan. That's what I go back to all the time is what is your business plan? What do you want to do? Do you want to hold something long term? Do you want to have that liability for a 30-year loan? Or do you want to just sell it, get it off your books?
And knowing that business plan might change too, right? So that's why different prepay penalties, you really have to think about what you want there as well. So most lenders in this space have a no prepay product, a 1-year prepay, a 3-year prepay, a 5-year prepay. And the longer the prepay penalty, the lower your interest rate's going to be. But if it's a market that's doing really, really well and there may be a good opportunity to sell that property in 2 to 4 years, maybe on that project you see if you cash flow at a higher interest rate but a lower prepay penalty, so that way you can sell it. And for anyone who doesn't know what a prepay penalty is, and I know we have some first timers on the call, which is awesome. In private lending, a prepay penalty, most people do a step down. Like I have a 5, 4, 3, 2, 1 in a 5-year prepay. That means any overage to your standard monthly payment, you'll get penalized by the percent you're in on that year. So if it's year 1, it'll be a 5% penalty. So you'll have to pay an additional 5%. Year 2 is 4%. So if you're in a 5-year prepay and on year 2 you try to pay off that property, on your payoff statement there's going to be a prepayment penalty of X percent. So that is just something to be aware of, especially when you're putting your loans together and potentially a portfolio loan instead of individual properties. There's pros and cons to both of these things, and people who are scaling quickly, I think, need to understand them the most. If you have a portfolio loan, it's a little bit easier to manage. It's one monthly payment instead of individually making sure that 10 to 20 payments goes through. But on the other side is you have release pricing. So what that means is if I have 10 properties, I have an allocated loan amount for each of those 10 properties. And if I'm going to take one of those properties to sell it before I sell the other 9, I'm going to get hit with not just a prepay penalty, but a release price. So if I have 10 properties and I know 5 of them I'm probably going to turn over in 3 years, but 5 of them I'm in for the long haul, you should split that into separate loans. So that way the release pricing and the prepays, you can kind of make them accordingly. Sorry,
Yeah,
that was a
and
lot.
no, it's perfect. If you have a good relationship with your lender too, they will also guide you in what the best decisions are, just depending on your business plan or what your goals are, and especially for portfolios too. Portfolios, I think sometimes, well, just in general, prepayment penalties in portfolios, people forget about the release pricing, and I have been called multiple times about, what is this fee on my payoff? What is this prepayment penalty? I didn't know about this. I didn't know that you're gonna have a release fee for me breaking up my 3-property portfolio. And it's just that's kind of the name of the game. And I try and do my best to explain all of that to people and coach them through it, because things like that can easily go missed or through the cracks. Ayanna, how has financing strategies played a role in the way that your clients have compounded their portfolios and strengthened their portfolios?
Yeah, so one thing that I've learned with working with investors is that the financing strategy is just as important as finding the property within itself. So the investors who scale successfully usually think long term. A lot of them are not just asking, can I buy this property? They're asking, how does this purchase position me for the next property? Almost always. So what this DSCR loan has allowed many investors is to continue to acquire properties without relying solely on the traditional income documentations that you will see on the other loans.
Oh, sorry. I kind of have I don't have pregnancy brain. I just have brain. I have slow brain. So
It gets worse.
sorry for the blank.
It gets worse if you decide to get pregnant. It's just like, so
Oh, I
excuse
can't.
me
Oh
right
gosh,
now.
I can't even imagine. My boyfriend, we joke about it all the time. He's like, "Oh man, you're gonna be a pain with the pregnancy brain." Uh, yeah, amazing. Yeah, having some sort of financing strategy and like how do you position yourself for the next property is very important. Sara was mentioning earlier about doing cash outs so that they can purchase their next property, and just having some sort of goal there in mind of like, what are you going to do with your cash out? We always want it to be business purpose, of course, so not to go and buy your grandma a new car, go buy some new handbags or whatever. We want to make sure that you're going to be in it for the long haul, and you're going to be a cycling investor too. We only have about 2 slides left, in about 15 minutes, so we're on perfect timing. Okay, common mistakes to avoid. This is a great one. Sara, what are the most common deal killers or red flags that you see when investors come to you for DSCR financing?
Yeah, this is a good one. I kind of have two parts. One of them is not necessarily deal killer. Sorry, Sydney.
I thought I muted it, sorry.
Nails on a chalkboard. No, just kidding. But one, I've talked about it a lot earlier, is telling the lender everything up front. Because a lot of lenders in this space have really unique rules about Airbnbs. Some don't do them at all. Pad splits, some will do them, some won't do them. Lending to, if you're lending to an entity, right? Maybe it's a nonprofit, maybe it is a boarding house, maybe it's a lot of corporate companies, like especially in the Dallas area, they buy corporate housing or rent corporate housing, not buy. And they put the lease in like the corporation's name, and some lenders won't lend if the lease is to a corporation, or if the lease is to a cousin, a girlfriend. You know, there's a lot of lenders with restrictions on these things. And you can usually find a lender who will do the deal just by their guidelines. So don't assume that every lender has the same requirements for this stuff, and really, you know, just be upfront with what type of lease it is. I, again, wouldn't say it's a deal killer, because I don't think it's a negative thing to do any of those. I think it's just making sure the lender you're currently talking to has a box that it fits. The other red flags we see, Sydney talked about this earlier, is the straw borrower concept, where, you know, you have one person who bought a property and their credit dropped pretty significantly, and so just to get the refinance done, they're adding somebody with high credit to the deal. What we'll look for is the HUD from when you bought the property, like who signed it? Was this high FICO borrower a part of that first deal? Were they involved? Or are you just adding them now, just to get, you know, the new loan through? So I think those are probably the most common deal killers and red flags in DSCR. I will say today as well, people are really looking at valuations a lot closer. Valuation's really, really important to lenders. You know, you can have an appraisal come in, and when you're reviewing it, the biggest telltale sign for me is when a borrower calls me and says, you know, hey, Sara, here's my numbers, $250K value, I'm getting $1,500 a month rent. When the appraisal comes back, if it's all of a sudden like $325 and it's way over what the borrower even expected it to be, that's when you know, need to have a conversation and make sure that we're sizing the deal appropriately. So I would say those are kind of the biggest things that we're looking at and thinking about today.
Yeah, and that kind of answered Eric's last question too. Would it matter to a DSCR lender if the subject property will be used for co-living or pad split model? I think earlier we were talking about like just letting your lender know everything that you can about the property, so it's not a surprise later on. But two, it also differs lender per lender. Some lenders are okay with it. Some lenders, they don't want to see that each of the doors is being rented out. It just really depends on the exact lender. And okay, well, Ayanna, what mistakes do you see newer investors make that end up hurting their portfolio's performance down the road?
One of the biggest mistakes that I see new investors make is I think that they underestimate the operations, which is what my job is, and they overestimate the cash flow. So a lot of investors, they calculate the mortgage and the rent, but they forget things like maintenance, vacancies, turnover costs, CapEx, management, tenant qualifications. And that's something that is very, very important. So, and another thing that I see is that a lot of investors aren't prepared to properly maintain. So what I mean by that too is the maintenance. do, like I said earlier on our call, is that we do semi-annual inspections. So what that does is it keeps an eye on the property for us so that we won't have to play catch up at the end of the lease terms whenever they decide to move out. Maybe it's 6 years later, and all that maintenance starts to occur, and we have to catch up, and it's affecting the rental retention and the profitability of the property itself.
Yeah, I think just as a new investor, like the most information you can get and the most mentorship that you can get, the better, because it's easy. It's really easy to make mistakes and to kind of just go into a bad investment and have a bad head on your shoulders about it. So having someone like you, property manager, who's an expert in the rental market in Houston, being able to make suggestions in how to enhance their portfolio in the long run is probably one of the best partnerships that you can have, really. Okay, we're on to our last slide of the webinar, how to think through your next rental deal. Sara, what numbers should someone run before they ever pick up the phone to call a lender?
Yeah, this is a really good question. I think figuring out, what is your cash flow on this property and what value do you need to hit to get there. A lot of times when someone buys a property and is doing a refinance, they run the numbers when they first bought the property and they never run them again. So if you're doing, the BRRRR method or even not the BRRRR method, just doing a refinance, you're using old numbers. And as we've seen over the last, 2 to 3 years, the market changes very quickly. And if you bought a property 8 months ago and are just now going for your refi, but using values and rental income that you picked 8 months ago, you need to go find better, newer comps for both value and rent. And just really making sure that you're doing the numbers first. I think what Ayanna mentioned just now in her last question was really important to point out, because most lenders are not taking all those extra expenses into consideration when just doing one property. It is truly just principal, interest, taxes, insurance, and an HOA fee if there is one. So if you are just doing what's applicable for the loan and not what you're really paying, that can be another thing that I think sets you back. And that goes to my scaling too fast. If you're just doing the numbers for my loan and what you're not actually paying, and you do that times 10, you're going to buy a lot more properties than you can actually afford to at that time. A lot of lenders, as you do larger loans or maybe a giant portfolio loan of, let's say 30 properties at once, they'll actually switch from PITIA debt service to net cash flow debt service. So that is a question you should ask your lender up front as well, is how do you calculate debt service? If they're using net cash flow, it means they're taking all of Ayanna's other assumptions into consideration. Vacancy, marketing expenses, property management fees, etc. If they're not using net cash flow, then they're really just doing principal, interest, taxes, insurance, and HOA if there is one. So just some things to keep in mind as you're vetting these projects. I would also say a really important thing is comparing like properties. I'll end my last question here with a funny story, in that I was originating a DSCR loan in the Midwest, and I got the appraisal back, and there was a pig in it, like a real live pig. And the appraiser took a picture of this pig, and right in the report it said like pig in room. And then the next picture was close up of pig in room. And I was like, well, that's a first. Okay. Is the pig paying rent? And the borrower was mad about the value on that property came in low, which is why I'm telling this story in the first place. And it didn't pencil to their numbers that they did before they called me. But I said, okay, send me your comps. When they sent me their comps, they were comparing, brand new construction, like luxury Airbnb rentals, to, you know, a property that was livable but not anything special, that had pigs living in it, that, you know, someone would not call luxury living. They would live there. It's like, you know, true workforce housing. And so just being able to point out those things to people is really important. So that way for the next deal, they're looking at it themselves.
Yeah, that's very important. I had one kind of not exactly similar. It was a new construction home, and the borrower was gonna sell it, but he had like this spare garage there for some reason, and he, as a hobby, he like raised bunnies or something like that. So there was a bunch of bunnies in the garage, and I was like, "What is going on here? Are we like we're raising bunnies, we're selling them? Like, what's the deal here? We're owning a farm, like." It's so interesting, but that pig story, that's hilarious. There's just a pig and then a close-up picture of the pig. Ayanna, you kind of answered this question already when helping a client. What does your process look like from first walkthrough to making an offer? So I'm gonna pivot it again. What does it look like when you are trying to essentially pitch your services to a landlord? How does that look like? Like, are they asking you certain questions? Are you giving them a whole pitch deck? What does that look like?
Yeah. So first, if a landlord's coming to me, excuse me, either from a referral, from the websites, from wherever, they fill out a link for me. We get on a call and I just introduce myself and I just want to learn a little bit more about them. Do they already have the property? Or where are we in the stages? And if they already have the property, I just want to learn, why are they looking for a property manager? Have they had a property manager before? And if the property is under contract, just getting to know all the information there. A lot of times is what I am trying to convey to the investor or landlord is that it is imperative that you have a property manager. I always like to use the contrast of you will never. I'm sorry, I thought my stuff was on Do Not Disturb. I'm sorry. I would tell the landlord investor, you will never go and extract your own teeth, or you'll never go self and diagnose yourself as a doctor, because that is not your specialty. So it's the same thing when it comes to property management. And then I just let them know what my services include. And I like to over deliver, because a lot of people think property managers are just collecting rent and plunging stopped up toilets. And it's not that at all. We are partners, making sure that your investment property is performing properly and making sure that your residents are happy. Resident retention is something that we truly love to stand on, and that's what separates us from a lot of property management companies. As they scale, they tend to forget that the resident or tenant is what drives your property. Without that, you don't really have any income coming in at all. So, but yeah, my process is either via Zoom, via phone call. I go take a look at the property. We do the official onboarding. And once we do the onboarding, I tell my clients, which is the landlords or the investors, that just look at it as mailbox money at this point. You should not be hands-on at all. But if you're one of those investors that you want to know what's going on with your property, we do have an owner's portal where you can see a snapshot of whatever is going on. With your property, work orders, income statements, whatever you need to see is going to be there. We do not hide anything at all. And then we also like to have, depending on how big your portfolio is, we like to either have monthly calls with our owners, or we like to have quarterly calls, and it completely depends on them. So we just make sure that we're overly communicating and making sure and letting them know that they're in the right hands. And that's for our local investors. Now, I also do, because I go to a lot of networking events, I do have investors that are out of town investors that, hey, they may not be able to, I can't work on their property directly, but I do offer landlord consulting. And then I also can connect them to landlords that are wherever they are, because I partner and I connect with a lot as well.
Yeah, perfect. Stephanie just asked a question if your company only covers Texas. So you kind of just covered that one, actually. I will have, so we're out of time. We're on an hour, which flew by, honestly. In the chat, I dropped over the WhatsApp group again, the Instagram handle, and our Facebook group as well. Sara and Ayanna, if you guys could just drop in your email addresses, so anyone who might want to reach out and ask any more questions or take use of your services, that they can just reach out to you directly. But that is all that I have for today, unless anyone else has any other questions. I'd love to still kind of answer them if we can, but we are just about out of time, but I'm going to leave it up for just a little bit longer in case anyone needs to go over the links or anything else. And yeah, perfect. Sara Hootstein, FACO Lending, and Ayanna at lumenlivingpm.com. If you join the WhatsApp group, I'm actually going to drop in their contact information as well, so that you can have that accessible there too. But that is it for today. Thank you, Sara, and thank you, Ayanna, for joining. Thank you, everyone, all of our viewers, for being a part. I am looking forward to our next one, which is actually going to be with brokers. So we're going to have a couple of broker sponsors, broker panelists on, and just talking about the world of brokers and how it works and lender partnerships and all of the good stuff. But we'll drop that link in the WhatsApp group as well. But yeah, that is it for today. Thank you guys so much again for joining on.
Thanks.
Thank you.